Welcome to this month's Trade Floor Update. My name's John Valtwees and I'm joined today by Rob Mead. For the last few weeks we've been talking a lot about our latest cyclical outlook, dealing with an inflation head fake. And essentially the key takeouts related to that latest piece of research are focusing on inflation. Inflation has been a really big driver of markets year to date. Our base case is that we do think inflation is likely to be bumpy over the next few months as it recovers. And that's really consistent with the positive news flow that we're seeing from economic data, the continuing vaccine rollout, and of course the enormous support from policymakers. And when I say that, I'm really referring to the ongoing supportive approaches from central banks across the globe, including here in Australia, as well as the fiscal forces that are supporting this ongoing recovery. Great examples include the massive infrastructure spending that is being rolled out in the US. Now, given that backdrop, we do expect bond yields to rise. Under that scenario, it's also likely that bond yields could potentially leak higher over the next few months. Rob, bringing that into markets today, what does that mean for bonds? But I also would like you to talk to some of the frameworks that are evolving, including the Fed. And the Fed has moved to this more outcome-based approach to inflation versus a more objective-based framework for inflation. So could you comment on that?
Yeah, you characterised it beautifully, John. I think it's when you think about what central banks want to achieve, they want to let economies run a little hot. So they do, exactly as you said, want to actually observe inflation rather than just forecast inflation. Now, that's all well and good. Now, whether or not they can achieve that is a question mark. So when it comes to investing, we want to take into account what that looks like, but also say what are the potential risk factors that prevent that escape velocity occurring finally since the GFC. So in Australia, there are some concerns that now, despite the fact that the RBA continues to reiterate that policy will be loose and that all of their forecasts are going up, their forecast for inflation, growth and employment all rising, we still think there's a couple of warning signs. So we are looking very closely at the upcoming budget, where we think while it will be stimulatory, it won't be anywhere near as stimulatory as, say, in the US, as you reflected. Also the vaccine rollout, it's been incredibly slow. So what that means for Australia is that international borders are likely to reopen much later, and which also means that some sort of defensiveness needs to be maintained in a portfolio because this rosy outlook may not materialise. And as you talked about a little earlier, interest rates are starting to move up, so the defensiveness of bonds is returning.
So given that backdrop of higher bond yields, and year to date we have seen bond yields move significantly, and that's reflected in some of the performance year to date. And in a lot of the discussions that we're having with our clients, they're concerned about the potential for ongoing weakness in bond portfolios and their targets to achieve their client outcomes. Yeah. What's also challenging is to try and communicate the ongoing benefits of bonds. They're continuing to be defensive, they can bring diversification through their low correlation with other asset classes. But more importantly, one key message we're trying to communicate is that with bond yields moving higher, that also means future income levels are also higher.
Yeah.
Simply by example, an Australian bond portfolio today is going to yield you over 2.5%. How do you respond to that challenge of trying to communicate those defensive and higher income producing characteristics of bonds in the environment you've just described?
It's a great way to portray it, and I think that we always try to talk about these things in as simpler fashion as possible because investing, you need to simplify it as much as possible. So when it comes to making investment decisions, we think across different risk factors or risk premiums. And when I look at the way that different risk premiums, like including equity risk premium or complexity premium, illiquidity premium, and then even interest rate or term premium, the way those premiums evolve over time gives you an insight into where value lies or what's expensive and cheap. And when I look across those risk premiums, only one of them is repriced, which is exactly as you said, interest rate risk. And so rather than looking less attractive, it's actually looking more attractive. And providing that income, providing that defensiveness, given that the interest rate curves have steepened significantly, And we won't dwell into it and go into it in this call, but the roll down yield curves and all of those great capital generating opportunities have returned. The other thing I'd mention on risk premiums is that illiquidity and complexity premium are also fair to cheap. So we're seeing plenty of different bottom-up opportunities, sometimes a lot less liquid, but plenty of bottom-up opportunities are continuing to materialise.
And there's some really good points that you highlight, that there are many different sources of return or yield generation within a bond portfolio, for instance. Jumping to another topic, albeit a very topical and popular subject, and that is home prices. And I would certainly love to hear your thoughts on the outlook for Australian home prices, but I really want to dive a little bit deeper into, with all of this housing market activity locally and even other locations around the globe, surely it presents a lot more investment opportunities. You know, quite simply, surely there's a lot more mortgage issuance from a local perspective that people like PIMCO and other investors can tap into for, you know, really high quality sources of income and other instruments that can preserve capital. Could you comment on that and give us some insights into what that all means?
Yeah, so it's on the monthly trade floor video, it's probably not appropriate to make a short-term forecast for house prices, but I think there's some really important elements in terms of the PIMCO portfolio. So first thing is we have positions in RMBS. So RMBS securities or residential mortgage-backed securities benefit if house prices go up. Typically what populates one of those securities are mortgages written 2 or 3 years ago. So the more price appreciation, the more credit protection. Second thing is that there's not much supply coming because the central bank and the RBA especially are providing such cheap finance to the banks. So the nice thing about RMBS is every single month as individuals pay their mortgages back, the principal amount of an RMBS security shrinks, so it amortizes. So every day you need to replace what's slowly amortizing away in your portfolio. So it means that the portfolio managers, our analysts around the world, are constantly looking for both secondary market and primary market opportunities to refill that bucket in the portfolio. Some of those opportunities are coming from the non-bank sectors in Australia, but also we're finding great opportunities all over the world to replace what would be typically coming from the major banks in Australia into Aussie dollar denominated securities.
Well, thanks for sharing those insights today, Rob.
Pleasure.
And thank you for taking the time to listen to today's Trade Floor Update. To learn more about our inflation head fake outlook, please visit pimco.com.au.